Jitendra, first to you. A busy day in the tech sector, but for Amazon, the stock is now up 2% on this beat. Some concerns about next quarter. What do you make of the results?
For the last 4 quarters, there's a trend over here. Inline revenue, massive beat on profits. And basically, like you said, they're squeezing efficiencies out of the investments. Advertising margin contribution continues to be strong. AWS growth continues to be strong. So what we are seeing the concern building about spending is, they're moving from Prime 2-day shipping to offer more Prime 1-day shipping to sort of secure their market share longer term. And that's where the incremental spending is going to come from, apart from, their expansion in AWS internationally, logistics expansion, content expansion, things like that. But what this quarter shows us is they are managing profits well, so expect steady revenue growth story, but profit growth longer term would be higher.
Guru, one of the things I find so fascinating about Amazon now is that it's less and less a retail business and more an e-commerce marketplace. Now, you run a company that advises brands on how to sell to Amazon. You also, as I recall, worked at Amazon back in the day. To what extent is this a sort of moving target for you and your colleagues? I mean, your clients. We talk about the 1P business, which you deal with. And Jeff Bezos, in his recent shareholder letter, said the third parties are kicking the 1P butt. Yeah. Right. So what does that mean for you?
Yeah, it's a great question. I think as we see the trends that have happened on Amazon in the last, call it 8 quarters or so, there's a significant shift that we see in Amazon focusing more on profitability as opposed to sales growth. And it's really coming off of Amazon's stated goals around being hands of the wheel, eliminating people from various processes, starting to launch private label goods, and also, to your point, in sort of democratizing the marketplace in a way that 1Ps and 3Ps are starting to play on a more level playing field. For instance, what used to be available only for 1Ps like Subscribe and Save and Amazon Marketing Services are now available for 3Ps as well. So at the end of the day, the consumer's winning, but at the expense of 1Ps and 3Ps, trying to really compete with each other, and all that profitability is taken away and passed on to the consumer.
Well, anytime a giant online marketplace makes changes like this, people complain, right? And marketplace sellers have been complaining. The traditional complaint of the 1P seller who you work with has been counterfeits and fraud. Amazon's been trying to address this. Have they had success?
I think they're making big strides. They're starting to think about being very intentful about who is a 1P and who is a 3P. That is, if you're a brand manufacturer with a legitimate manufacturing business, then you are a 1P. However, if you're a distributor or wholesaler or somebody who's just aggregating demand and selling it, they're starting to move to a more 3P platform. There are rumors of a program called One Vendor, which is launching with Amazon, where there's a stated goal of having 3,000 to 5,000 vendors on the Amazon 1P platform and moving everybody else. The 1P business is not going away. It's just going to become a lot more consolidated to those who are legitimately brand manufacturers.
Jitendra, one point of friction for many sellers has been the advertising business. They find now that they are charged to appear high in search results. Some of them don't like it. Yet in the earnings report, I noticed that it seems like the growth rate for that ad business had slowed considerably. Are we reaching some kind of limit for how fast Amazon can put ads in search results and on the site?
So, well, first of all, there was an accounting change last year where they used to count cost or negative cost of sales, and now they start booking in revenue. And that gave a one-time step. So we are dealing with that. So the deceleration is not as big as we think it is. And second, if you take the other segment number, the ads business within it is going faster than that segment. What we see happening is, as the traffic goes and as Amazon goes after, video ads in their app, they're giving out more music services and things like that, they'll expand that ad inventory materially. As far as the pricing is concerned, theoretically, the ROI that Amazon can deliver on advertising should be the highest out there, because they have the data. They know exactly how much conversion you could get from this advertising. So I think it'll normalize the pricing, but right now I think the focus is on just driving profit margins by capturing these additional ad inventories that are going to come online.
We're seeing that a lot of the arbitrage opportunities that used to be there about a year ago are starting to go away. That is, it used to be easier to get a good advertising cost to spend, which Amazon calls ACoS, to have a very lucrative return on investment on your ads business on Amazon as a 1P or a 3P. Now that is starting to taper off because everybody's jumping onto the bandwagon because everybody realizes this is the only closed loop system out there where you can truly measure the ROI of your spend. And I think the bar is now pretty high, and you're going to see that the cost to spend on Amazon is going to just increase.
Jitendra, last question to you. We don't have a lot of time. The physical stores, right, growing in the low single digits. It shrank last quarter, so maybe it's an improvement. But have they figured it out yet with Whole Foods and the bookstores and the 4-star stores?
This will be a longer-term push for them. I mean, I think the opportunity in groceries is online. You know, the physical stores, they'll have to expand the physical stores to actually see that growth. But what they are seeing is all the price cuts helping drive growth a little bit more than what was before, but this will remain a single-digit story for now.